Happy Monday out there, and welcome to another edition of Macro Mondays. My name is Mikkel Rosenvold, and we have a great show for you today. I'm just joined as usual by you, Andreas, my usual co-host. Welcome to the show.
Hi, Mikkel.
A lot of big news today, a lot of interesting topics to cover, Andreas. We have tried to refrain from talking too much on the US election. I mean, there's a lot of analysis of that out there. But I mean, we have to touch upon it at some point. This picture did it for me. I was at my local McDonald's yesterday, to be transparent. I didn't see this in the window, unfortunately, but what a great photo. What a great momentum Trump has in this campaign at the moment. Do you think he's going to win it?
Well, I've said that all along the way, yes.
Yeah.
So yes, but I mean, who knows? But this is great political work.
Absolutely.
Let me put it like that.
I mean, I've dubbed this the meme election, the meme campaign.
Yeah.
Probably a more appropriate term would be the poly market election. That seems to be driving a lot of the headlines recently. We'll get back to that later in the show, Andreas.
Yeah, but honestly, Mikkel, I don't think it's completely ruled out that what we've seen over the past week is some sort of spillover from poly market, Trump's momentum to a lot of assets in financial markets. So
absolutely, and
something you need to watch out for. I mean, we're a couple of weeks away from the election, right? More or less. So.
And that's why we're discussing this. On today's agenda, we also have the second most memeable person in the world, Christine Lagarde. Very, very great at that. We'll get back to that, and we'll have a look at whether October holds reflation or deflation, which has great impact for global markets. But first, Andreas, last week I promised that we would have even more news this week, and I have to admit it's not the OnlyFans account everyone was looking for. It's something else entirely, Andreas. We're launching a new strategy, and we just wanted to put some words on what it is, because we're going to be using some of this in the show. Can you explain a little bit more, Andreas?
Yeah, so going forward, I will be the Chief Investment Officer of the Asgard Steno Global Macro Strategy, hedge fund placed in Denmark, based out of Ireland from a legal perspective. And it's a strategy designed on the back of our nowcasting technologies. We've teamed up with a few very interesting technology partners, seed investors, backers, to create a strategy that utilizes real-time data across a range of geographies, across a range of macro variables, to gain a time advantage on markets. And I think it's a very, very exciting project, one that I look very much forward to taking the lead on as Chief Investment Officer. As you know, I mean, we're Scandinavian in style, Mikkel, so we want to be transparent around what we do, and therefore we also want to mention this. Of course, it's a great opportunity to mention it. Let's just be honest about that as well. But from a transparency perspective, I think it's relevant for the audience of this show to know that we run a strategy. Yeah. It would be wrong not to say. So
in our view, at least, Andreas, this only strengthens our analysis. We have skin in the game now. We're not simply shooting left and right here. We're actually putting this all together in a strategy. Yeah. Does this mean that your and our independence is out the window, Andreas?
Well, since this strategy can trade everything, I don't really think I have any boundaries in terms of what I can say and do. So no, not really. My independence is intact, but well, obviously, as with every other strategy, as with every other firm, we'll have clients. That's kind of where the independence ends to some extent, right? But no, I don't think it changed the picture a whole lot from an independent standpoint.
No, and I mean, whenever we issue trade ideas or recommendations on this show, it's likely to be something we've already traded. In my view, that's only a strength. I mean, that only adds to the integrity. But obviously, we need to declare that's that. And this strategy is not going to be trading in assets that we can actively influence the price on. I mean,
it's not from this show. It's not an activist fund.
No, in that way. So that's just a little declaration. As said, a lot of the content that we're going to be using, a lot of our data models, which we'll get back to later in the show, are also actively leveraged in this by this strategy. So that's that.
Yeah, and the final thing I can mention is that I'll personally throw some $1 million at this strategy. So when we disclaim that we're sometimes maybe good, sometimes maybe shit, I will suffer myself if we're maybe shit. Put it like that. So, yeah.
So even more skin in the game on that. Yeah, absolutely, Andreas.
You want to unfuck your shit?
Yeah, that's being recorded.
Hey, listen, if you want to unfuck your future, then come and join us in the Real Vision community. Incredible platform, amazing content, some of the smartest people in the world, and amazing tools. And guess what? It'll cost you nothing. Come to realvision.com. I'll see you there, and let's help you unfuck your future.
Anyway, enough about that.
Yes.
Let's get back to the show on our agenda today. I just mentioned it. Let's start with the ECB cutting that we had late last week, Andreas. I don't know if it was nail biter. I just really love this picture of Christine Lagarde.
That's an old picture.
Yeah, it's a very old picture. It's not from last week.
No,
that's fake news. So 25 basis point cut as you expected, and also hints at more cuts.
Sure. I mean, it's basically the only cutting cycle that seems to be alive from sort of a momentum perspective. We've seen how U.S. officials have kind of backpedaled a little bit on the cutting cycle after the 50 basis points. At least the data has been too strong lately for them to really promise a whole lot more. In the European Union, we have terrible data from some of the core countries still. Take the example of Germany. If you look at the industrial production in Germany, in energy-sensitive sectors, we're basically more or less below the initial lockdown in 2020. And I mean, who would have thought that post the reopening, Germany couldn't even post a comeback?
No.
Initially it did, but then we had the energy crisis, and Germany is moving nowhere right now. Of course, as a consequence of an abysmal energy policy, and of course to some extent also related to events that were sort of out of their control. But anyway, we're talking about an economic engine in Europe that is no longer thriving, basically, and even with gas prices coming lower, natural gas prices in this relation, even with electricity prices coming lower, and we're talking about a lot lower than they were in 23. We don't really see a rebound in the German industrial economy. So it seems like they've lost competitiveness and they've lost production power for good.
And that's the point, Andreas. How much can lower rates help this? How much can rate cutting help this?
Yeah, of course, to some extent, right? But they will have to alter the guidance on their energy policy as well. For those of you who are not familiar with German politics, and I'd like your take on it as well, Mikkel, the current coalition is a bit of an odd one out in the sense that we have a mixture of parties basically across the center of the aisle combined in a coalition. And the one thing they had to sort of agree upon when they entered office was to close down the nuclear plants. The party called FDP was not necessarily in favor of it, but they accepted it as part of the bigger package. But the quote unquote typical Chancellor Party, at least if you look at the past 15 years, Angela Merkel's old party, they're now running on a platform where they basically plan potentially on reopening these nuclear plants. So I think there is a clear opposition to the current policy mix in Germany that could potentially revive things. But in any case, I mean, it's not like the production price is high right now in Germany, but due to these political changes, that they've kind of lost this production for good, it seems. It will be very hard to convince people to get back there.
Absolutely. And I mean, we are seeing in many ways a reversal of Merkel-era policies, both in the energy, especially the links to Russia, but also in the fiscal policy. Angela Merkel was very much an austerity chancellor. And it seems like Germany, as is all of Europe, is now moving towards bigger public investment simply to match what's going on in the US and China. I think the EU and Germany in particular has been caught a little wrong-footed by the massive public investments into the industrial sector, the very active industrial policies being conducted in the US and China, and Europe is trying to catch up on that, which is admittedly quite hard because the entire EU is built to avoid that or to combat that. So it is a very tricky situation. So yeah, essentially we're expecting more rate cuts out of the ECB.
Yeah, so I mean, the bottom line of all of this is that it's basically the central bank with the best scope to cut interest rates from here. If you look at the forward pricing of euro rates relative to what you would consider neutral, I still think that we're pricing late maybe like 50 basis points above neutral in Europe if you use the Lorbeck-Williams model to assess the neutral rate. We're pricing above neutral in the US again as well, also in sterling markets. So I think what we can gather from that information is that the market is not convinced that interest rates are sufficiently restrictive to bring down the consumption levels and the activity levels in the US and in the UK to an extent needed to bring inflation down, while the market is slowly but surely acknowledging that Europe is actually suffering from high interest rates. And whether you like it or not, it will be at least a partial game changer for Germany, France, etc. if we get some lower interest rates. For now, the market is actually pricing a pretty decent risk of a 50 basis point cut from the European Central Bank in December. I think that's maybe exaggerating things a little bit, since the ECB is known as like a bureaucratic institution. It's not really like a first mover. Of course, we got that 50 basis points cut from the Federal Reserve, but it's very rare that the ECB wants to move fast ahead of other central banks. So I think they'll go ahead with 25, 25, 25, 25, 25, 25, just continuing for a long while.
Yeah. And maybe a gap opening up with the Fed. We'll get more into that, Andreas. Let's turn our heads across the pond to the US. Andreas, over the past week, we've seen some very strong trends in the US dollar trade gaining momentum in recent weeks, perhaps following the Trump momentum that we talked about earlier. What's going on in the dollar?
So I don't think there's any doubt that Donald Trump is seen as a strong dollar candidate due to tariffs, due to trade wars, due to his clear rhetoric against trade partners on the dollar's status as a reserve currency. I think he explicitly stated that if a trade partner is trying to circumvent the dollar as the trade venue, they'll get 100% tariffs thrown at them, right? So the attempts, and admittedly early attempts we've seen from BRICS countries and other countries to try and circumvent the dollar, he will respond to such attempts. So I think that's basically what's ongoing here. Of course, alongside this divergence that we see between US and European macro data, especially on growth, right? But as you can see from the chart here, I mean, at least the timing sort of coincides with the repricing of the odds or the probabilities of Trump winning the election. Whether, I mean, we can have a discussion on that now that we're at it, Mikkel. And we're talking real clear politics betting averages on Donald Trump here, but it seems like it's very influenced by the poly market.
Absolutely. Yeah. We can maybe move on to the poly market right here. So over the past weeks, a month, we've seen a very, very, very clear move towards Trump. Only partially in polls. We've seen that over the past week or two, but way more significantly in the betting markets. Obviously, huge amounts of dollars being invested in this. So it is a relatively liquid market as betting markets go. In my opinion, this 60-40 advantage to Trump is maybe a little bit high. It's still very, very hard for me and others to digest the data we're getting from early voting, because we're comparing a lot to 2020. But remember, 2020 was a lockdown year, so a lot of people might have been incentivized to vote by mail. Will that keep on right now? What are we comparing against? That's very, very tricky. So the tricky part here is to gauge the turnout percentage. If we have a voter turnout of 70%, I believe Donald Trump is toast. If it's 60, like 8 years ago, Donald Trump has a great chance. If it's anywhere in between, like last time, let's see. So in my opinion, Trump absolutely has the momentum right now. Perhaps the causality is turned around here, because is this momentum built from positive wins on the poly markets of this world? I mean, we know that a lot of Republican institutions have released polls which are favorable to Trump. They're not being counted in many of these more trustworthy averages, because they're simply pumping out a lot of low quality polls. But I mean, they are influencing the media and the news stream with positive stories of how well things are going for Donald Trump. So is this momentum feeding into the betting market, or is the betting market feeding into the momentum? There is some level of circularity there.
Yeah.
In any case, we are looking at a Donald Trump momentum right now. We had a very big Atlas poll by the end of last week, signaling strong numbers for Donald Trump with a lot of respondents. So I am still leading Trump, but to me, it's a little bit closer than 60-40 perhaps.
Yeah, and I mean, this whole conundrum around the trader called Freddy9999 on Polymarket, he's been extremely active in this Trump bet, and I think net he's probably betting like $15-20 million on Trump winning the election now. And who is Freddy999?
Is it Elon?
It's my username on Pornhub, but I'm not involved in this one. So I mean, could it be someone close to the campaign? Could it be someone linked to one of the super PACs supporting Trump? Could it be Elon? Could it be Peter Thiel? I mean, it is an anonymous market, right? And I'm not here to like trying to speculate who it is, but at least we know that one trader is pretty actively trying to bid out the market. And then we had like the
fluke last night.
Yes.
That's the one. That's why I brought on this chart, this lower chart here, because on Sunday, suddenly we had a huge spike in Kamala Harris percentages. Going upwards of 45% and then being traded off again, seemingly. So, in my opinion, this poly market is working a bit more like an asset, like a stock price, with a lot of speculation on the percentages rather than a poll. It's still a very interesting chart, still very interesting to follow because this is getting liquid enough that these spikes, that these speculations are getting marketed out, if you know what I mean. So, really interesting to follow this.
And in my opinion, this is a better market to follow than opinion polls. Skin in the game is always worth pursuing, in a sense. And those involved in this market, they have skin in the game. I mean, it's not a sort of a free lunch to just say whatever, right? You actually lose money if you're wrong. So why would you try and like move the market a lot in one direction? Of course you could. I mean, your argument is basically that you can build momentum from the momentum in this market. Right? So in that sense, it's kind of an odd market where you maybe influence the end result by adding momentum to it. I wouldn't rule that out. But
I mean, by that logic, everyone investing in stocks and FX, whatever, they would all sit down and try and calculate the equilibrium price and invest towards that.
Yeah.
That's basically what you have here. Is if people think that the percentage, the likelihood is 60-40, they would invest towards that. In my opinion, people don't invest like that. They invest based on what everyone else thinks to gain these short momentum, and that can be seen here. A counterpoint is that polling institutes are have a lot of skin in the game as well. If they fuck up this, don't fuck this up, as Will would have said. if they fuck up this election cycle, no one is going to be buying polls from them for the next 4 years.
Nope.
So they have a lot of skin in the game as well. On the other hand, that also means that they are also unlikely to be pissing against the wind. Isn't that the word you're often using? So what on earth can we trust here? We can trust some of the early voting data, but it's very, very hard to know what to compare it to.
My impression is that Trump is the main. He's the favorite now. I mean, he's got to be that.
I agree completely, except the fact that we may have a really high turnout. And it's still the fact that the more voters you get out there, the better the chances of Kamala winning. Because this is not an election where you flip votes over the middle. This is a pure turnout election. And I have some idea, maybe down to the weather on election day in some of the swing states. I have a feeling we're going to get close to 70%. Of that might just be too much for Trump to make the math work. We'll see. Going to be very, very interesting also for markets, obviously, for the U.S. economy long term.
But Mikkel, can we have a look at the macro backdrop ahead of this election in the U.S.? Because I think that's kind of worthwhile discussing here. Strong dollar, signs of higher inflation expectations, kind of a sudden halt to the trend towards lower dollar interest rates. Those three trends have at least historically been connected to Trump gaining momentum. We also saw that in the run-up to 2016 and after his election victory and all that. But it's also partially driven by the economy, actually, here. It's not just a Trump bet, right?
No.
So this is our nowcasting technique shown in a chart, right? And we had this pretty nasty drawdown in activity through July and August. It was also visible in hiring data. It was visible in inflation data and all that. And you can see from the light blue that we've regained momentum in the US economy, more or less since early September. Basically, just when everyone started to expecting a lot of cuts, we got some sort of boost out of that. Inflation expectations, the dark blue, boom, up as well. At least until the oil price started receding a little bit last week. We can see whether, let's see whether it will recede through this week, the oil price, with all of the turmoil in the Middle East again. But the point here is that the economy is actually doing fine. And that was not the conclusion 2 months ago. This leads to the question, okay, we've seen reflation in many ways, both in growth expectations and in inflation expectations. But is October and November, and to some extent December, is that a good timing to expect that? And my best guess is no. If you look at the hit ratios of betting on higher versus lower inflation in October, historically in the US, you have a much better hit ratio betting on lower inflation compared to higher inflation.
Compared
to expectations, basically.
Compared to the consensus,
And why is that? Well, typically we see some moves towards higher inflation expectations in September. It's all very, very stubborn pattern. And we also saw that maybe just postponed by a week or two this year. And on top of that, it's also driven by seasonality and everything related to commodities, energy markets, and so on and so forth. What's different this year is that we have a labor market that we still need to be painfully aware of. And I mean, I know we got a better than expected job report early this month, but there are some signs beneath the hood that we will actually get some weaker data from the U.S. labor market. And let me show you just a few glimpses of that, because there's no doubt that nowcasting the U.S. economy right now leads you to the conclusion that the U.S. is doing fine. Absolutely fine. Europe is not doing fine. It's a classic divergence case. But when you look at the labor market and some of the surveys that could typically hint where we're heading, we're talking about jobs hard to get versus jobs plentiful in the consumer survey. So basically asking people, okay, what's your vibe right now? Is it easy to get a new job? Do you see a lot of job openings? That's that kind of vibe, right? And when we're asking, the regular American, that question right now, we're getting the response that it's not as easy as it was.
No.
And that's a very, very typical pattern to see ahead of unemployment actually spiking a bit. We're not seeing the kind of through the roof momentum in the survey as we typically do in recessions. It's rather like a slow grind towards higher levels, which probably speaks in favor of like some sort of light labor market recession. Nothing really worrying, but still probably enough for the Fed to care about it. And then when you square it with one of the few but noteworthy observations from the US economy that is actually decelerating now, retail sales. Last week, we got the retail sales report from last month, so September, and it looked brilliant. But when you look at the Chicago cards data, it's basically a time series that's been set up by the Chicago Federal Reserve System, trying to gauge retail sales more frequently than the retail sales report. You had a very nasty last week to September, and it seems like October is off to a bad start as well. And as you can see, it's one of the larger drawdowns that we've seen in a while. And I really struggle to explain what happened there, but it's definitely worth watching because, I mean, spending is obviously what keeps the U.S. economy alive right now. Final point I'll make on this relates to construction, because on Friday, we had some pretty weak numbers out on permits and construction in the U.S. again. And this gap has been pretty nasty to watch for a while. So construction payrolls are going up. We actually made a new cycle high in the last non-farm payrolls report. But the number of permits is going down. And of course, it takes a while for a permit to filter all the way through to a construction job, right?
But it will eventually.
It will eventually.
Inevitable, yeah.
So how do I explain this gap right now, and why haven't we seen a drawdown in construction payrolls? Because of the Inflation Reduction Act, because of the Chips and Science Act, we've seen loads of manufacturing jobs in R&D sites, manufacturing, building of factories, all that. But the IRA stimulus is also fading from like a marginal perspective. So we need permits to rebound soon. And I sincerely mean soon.
To keep the job market alive.
Yes.
Yeah.
Final point on that. Okay, I have many final points today. Mortgage rates, right?
Yeah.
In relation to this. So mortgage rates have dropped, more than a percentage point on the year. More than that if you look at the most recent peak to trough.
It's inverted on this.
It's inverted, yes. When you see such a drop in mortgage rates, you typically see a pickup in permits. Not because bureaucrats all of a sudden figure out that they have to issue more permits, but obviously because you see more applications,
it's
right?
Incentive, yeah. That should be one of the most direct links from loan mortgage. Yeah.
So maybe we'll get there in time. And if this chart is correct, we'll probably see a very soft landing, right? Because you get permits up and running in time for the labor market to sort of absorb that construction payrolls will dwindle a little bit in other sectors and so on and so forth. But the underlying prerequisite here is that the Fed will keep cutting interest rates.
Yeah.
Otherwise, I think we're toast. So even if everything's okay, they need to go to neutral, and I think the Fed knows. So I'm not overly convinced that this was it for the Fed cutting cycle, and they will have to skip the next meeting and all that, because they've painted themselves into a corner. If they want to save the construction cycle, they'll have to keep on cutting.
Yes, and perhaps that leads back to one of the fundamental questions about the Fed. Are they combating inflation or are they combating unemployment, essentially?
Unemployment.
Exactly.
Yeah, they're trying to combat what they think is an upcoming unemployment problem.
Exactly.
Yeah.
So these last few charts might be even more important for the Fed than the inflation prints.
Yes.
Essentially.
I still think that.
Very, very interesting. We'll see in coming weeks and months. And just want to round off by showing a little bit more of our regime models from our nowcasting tool.
Yeah.
Just moving ahead here. Obviously, we had the US here. We talked about the Eurozone as well. I just wanted to touch on China here. I know this is a trickier nowcasting to run than the US, perhaps. What are you seeing right now out of China? Are we seeing some delayed effects to the Beijing bazooka we talked about last week, or things still relatively stale out there?
Well, as you can see, we actually did get a pretty decent spike in Chinese activity around that first announcement.
Yeah.
Goes to show that nowcasting works, right?
Yeah.
Because otherwise you would be sitting there, okay, I don't know whether it worked or not. But it also shows that we've kind of peaked, right? And it's been one hell of a ride. I mean, we've been involved a little on the long side and then ultimately on the short side in this China trade, and we've made money on the way up and on the way down. Because of this. Otherwise, I would have no whatsoever clue what was going on ground in China. But we're using box office sales, metro numbers, pollution data, lighting data, so creative stuff to get some sort of real-time activity gauge from China. And that's basically what you need to be able to trade copper, iron ore, Hang Seng, all that. So it looks peakish, and we've been, since we've seen that, I mean, we have some rules on when to implement longs and shorts given how much the probability changes. And since we've seen a drop in the probability in China of rising growth of, say, 15 to 20 percentage points, it's been enough for us to implement shorts, and we've made money on it. So we're leaning short here on China. That's
very interesting, because when I just look at this, there are some movements going at high probability of rising growth, high probability of rising liquidity with relatively low inflation. That should almost be gung-ho territory.
It sounds perfect. And it was gung-ho territory for 3 weeks. But we're now moving towards a trajectory of lower probabilities of rising growth and rising liquidity, for example. Mm-hmm. And that's probably the last thing I'll say today on this. It doesn't really matter whether it's a 0% probability of rising growth or 100% probability of rising growth. The rate of change is what matters, because, I mean, we're obviously not the only ones worldwide looking at stuff like this. So when the probability changes from 0 to 20, it alters the outcome space for an economy, and that filters directly into asset prices.
And that's also why in 2 weeks we might be on the other side of this China trade.
Sure.
If our model tells us that. Just to give a little glimpse into our thinking here. To round this off, Andreas, just a little sneak peek into our current positioning. The Hang Seng trade, interesting from what we just talked on with China. What else is most remarkable in our current positioning?
As you can see, we're along the Schatz foot, so basically betting on lower interest rates in Europe, and we've been betting on that for a few weeks. We have that position on against some positions in the dollar market, and it's pretty clear from this basket trade in the U.S. equity market versus the German equity market that we're betting on the U.S. outperforming Europe. We're also betting on Nasdaq outperforming Hang Seng, so some sort of intangible bet on the U.S. outperforming China. That's basically the main takeaway right now, that we're leaning into U.S. Basically across the board versus peers.
Yeah, but remember, these are short-term trades. This is tactical positioning. So if you're watching this in a few weeks, watch the latest show. That's the best advice we can give. I just want to round off with the last one, Andreas. I really love that. That's the Viktor Orban trade, right? The Hungarian forint.
Yeah, but we have that. We have the Viktor Orban trade on permanently. Yeah, good guy.
Great stuff, Andreas.
Am I allowed to say that? He's a good guy? I don't know. I'll be thrown out of the European Union soon.
I'm sure he's a good father and everything. Yeah. So there's always that. Yeah. Anyway, Andreas, that's all we had for this week's show. Yeah. We'll be back next week with a lot more coverage of global macro, our view on models.
We need the disclaimer now that we're talking about this, Mikkel.
Absolutely.
And even more so this week with the announcement we've made. Yeah.
Especially, remember that even though we believe we have good footing for this and we believe that this is the best way to head, remember that we might still be.
Sometimes maybe good, sometimes maybe shit.
Absolutely.
And Mikkel, I've promised our employees that we will buy them either a vest or a jacket with the disclaimer, sometimes maybe good, sometimes maybe shit, posted on the chest here. Yeah. Yes, it sounds expensive, but yeah. Anyway, we are sometimes maybe good, sometimes maybe shit.
We have to do that, right? If you have any recommendations for clothing for our employees, please link them in the comment section. Otherwise, we'll be back next week. Thanks a lot for watching.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.